Okay, for this video, I wanted to talk about how using a home equity line of credit could save you some tax dollars every year. So the situation we have in front of us is we have a homeowner who owns his home and he is looking to renovate a part of the property, right? And so now the question is, well, how do I finance the renovations? Do I pay cash? Do I go borrow from a third-party lender? Do I put it on a credit card? Do I go to a third-party investor and borrow the money that way? How do I go about this, and what is the best option perhaps from a tax perspective? So just some background here on how the mortgage interest works. When you have mortgage interest, that is interest that's being paid on a loan that was used to purchase a house, and it is secured by that same home, right? This can be either your main home or a second home, and the interest expense or the interest payments you make on a yearly basis can be included on Schedule A as an itemized tax deduction. And so if you itemize your deductions, you're effectively getting a tax deduction for the mortgage interest paid during the year. Now, the baseline is mortgage interest is generally fully deductible. The only time that you might have non-deductible interest is if you borrow basically enough money for an expensive house, right? So for loans incurred after December 2017, if you have interest that's incurred on debt over $750,000, that's going to be non-deductible mortgage interest. So these tax laws were changed within the last few years. Effectively, we had taxpayers borrowing $20 million to buy a mansion, and they were writing off all the interest, and so so Congress changed the rules and said, well, look, you can still write off mortgage interest, but if you're borrowing in excess of $750,000, it means that you're already rich, you've got enough money, you don't need that full mortgage interest deduction, and so that's why the deduction for the mortgage interest starts to phase out once you hit these thresholds, okay? So in this example, let's say we have an individual buys a house for $2 million, they borrow 1.6. The interest expense that they're paying the bank is computed on this full 1.6, but they're only allowed to deduct the portion that's attributed to the first $750K. All the extra mortgage interest has to be left off of Schedule A, and then it's just gone, right? They can't deduct it. Okay, so and then how does the home equity line of credit or HELO interest work? Well, interest on a HELO is treated in the same fashion, right? So if you have interest on a home equity line of credit or a second mortgage, it's going to be deductible so long as the proceeds were used to buy, build, or substantially improve that home. So, for example, you can't pull money on a HELO and then use it to go buy a boat. If you do that, the interest on the HELO that you're paying isn't going to be deductible on Schedule A, right? It's got to be money used to renovate or substantially improve the home, okay? That's important. So let's look at our fact pattern here and then look at some of the options. So John buys a house for $400K and he borrows $300. So you put up $100 in equity, borrowed $300 to finance the purchase of the home. After a couple years of payments, he now has $150K in equity into the home, and he's looking to renovate the basement. So he's trying to figure out, how do I finance these renovations? And he thinks they're going to cost about $50K. So right now, John's yearly payments on the mortgage are $15,000, and he pays, of that, it's about $10,000 in interest. Obviously, the interest amount changes every year, but for the most part, it's kind of hovering around there. And so he's reporting this on Schedule A as an itemized deduction, and he also has property taxes and charitable contributions, so he's itemizing deductions every year. Now, that's an important distinction, because if you find that you don't have enough interest, taxes, charitable contributions, and the like, and you're not itemizing deductions, then these types of scenarios might not really apply to you. This discussion about whether you can use a HELO really kind of depends on whether you can itemize deductions. If you're using the standard deduction, might not help so much, okay? So what are his options? Well, the first one obviously is just fund the renovations with cash, right? So if you put cash into your property, the cash you spend is obviously going into the home, it's increasing the value, it's increasing your basis, but you get no current tax deduction for anything you're doing, right? So the $50K in cash just goes in, that's it. So the opportunity cost here for the homeowner is, how could you have otherwise invested those cash assets, right? So, for example, could you just take the $50K and invest it in the stock market, earn 5% a year, that's the trade-off here. Once you spend the cash on the renovations, you're losing out on the opportunity to invest in other income-producing assets. So the second option is, well, maybe I don't spend the cash, maybe I fund the renovations with a loan from a third-party investor. If you're going to do that and you're going to fund the renovations with borrowed money from somebody else, the interest expense that's incurred on that note is generally not going to be tax deductible, right? And that's going to happen for really one big reason, right? So when you borrow money in that kind of fashion, the third-party lender isn't going to have a security interest in the home, and that's important, that's necessary. So you have to borrow the money, use it to renovate the home, and the lender needs to have a security interest in the home to make sure that it qualifies as this deductible mortgage or HELO interest on Schedule A. Otherwise, it's almost just treated like credit card debt, right? It's interest spent, but it's not really investment interest. It's not mortgage interest. You just pay it, and that's it. That's the end of it. So then the last option here is this HELO option, right? So what if you fund the renovations by taking out a home equity line of credit on the property? So you go to your bank, you take out a HELO, you start drawing down on it, you pay an interest. How does this change everything? Well, if you borrow the money, you use it to complete the renovations for the property. That's the first point met, right? That's good. And then the second piece is the lender, your bank, is going to secure the HELO with the property itself, right? That's why it's a home equity line of credit. So the interest is going to qualify as deductible interest on the residence. So you will be able to add it to Schedule A as an itemized deduction. So if John goes this route, what he's going to do is he's going to keep reporting the $10,000 in mortgage interest he pays every year, and his charitable contributions, his property taxes, and then in addition to that $10K of initial mortgage interest from that first loan, he can add the interest paid on this HELO related to the renovations. So he's going to get a tax deduction on the interest expense paid to renovate the property. And so that's why it's often really, really good for a lot of homeowners to finance renovating their home through a HELO rather than some other option. So if you have cash, save it, don't spend it. Do not go the credit card route. Do not go with a third-party lender that is going to give you an unsecured note with a really high interest rate, because you're not benefiting from those interest payments at all. So the HELO is probably a good option for you. Obviously, everybody's circumstances are unique, so it's very careful to analyze all these options, but this is how the home equity line of credit for renovations can help you save some taxes, because it's going to increase your itemized deductions every single year. Okay, so that covers it for this video. I hope that was helpful. If you have any questions, leave me a comment below, and I look forward to seeing you again soon. Thank you.